Guys, I'm going to take you on a 30-minute personal discovery when it comes to property acceleration in the UK today. There's never been a better time to invest and build in property. Regardless of what's going on in the Renters' Rights Bill, there's an expected 5 million more people to enter the UK. So the opportunities to create wealth by accelerating equity through equity itself is what I'm going to take you through. There's a few bits that get quite complicated, but some things are. But we can then run that in further exclusive webinars through the Wealthy Property Club as we move forward. So the formula that I've used for over 30 years, and that was taught to me and has been fine-tuned by people far more intelligent than me, is the following. Take the first. Currently, 4.6 million buy-to-lets in the UK. 55% of them have no debt whatsoever. The vast majority which are indebted, unfortunately, are held in personal ownership. And I think you'll know what I mean by unfortunate. With the recent George Osborne tax changes on interest relief, means those that have buy-to-let in personal names are at a disadvantage when it comes to offsetting interest relief, lender fees, and IHT mitigation. Next is the structure of ownership, and that kind of splits it the two ways. Predominantly, the vast majority of indebted buy-to-lets are held in personal names, and unfortunately, most likely joint tenants, not tenants in common, which is the difference between profit and loss just there and then for the vast majority of people. So if you don't understand the differences between moving 99 to 1 in favour of a basic rate taxpayer and a bespoke ICR, it's the difference between losing and making money. And then limited companies, which are not complicated, but it's about a journey of understanding your basic DNA of a limited company and understanding how that transition goes to family trusts and how you can protect succession and IHT planning. We then come to yield, and yield is a complicated journey of involvement, and it's about understanding how yield works. The standard family let is your basic yield. Then you might move into a HMO. Then you might move into a complex HMO. And then that HMO might be rented out on short-term let, serviced accommodation. So HMOs now are categorized in effect as holiday lets. We then move into interest rates. It's understanding interest rates, and most mortgage advisors make a fundamental mistake. If you've got two options, one payment £1,000 a month and one payment £1,100 a month, which is the cheapest payment? £1,000 a month or £1,100? It's irrelevant. It's the structure of ownership first. Because if you take your £1,100 a month in a limited company, you can offset every penny of that against tax. £1,000 a month in personal names for a top rate taxpayer, you're only able to offset £200. So if you ever advise on rate before structure, it's a fundamental flaw. So when we start to build that whole profit concept and we think about where we're going, let's just look at how we can accelerate. And I remember seeing Terry, who was very young, very impressionable all those years ago, writing every note. And over the years, as I checked in with him, he was saying, Rog, I followed your formula. I'm buying, it's working, it's going. And it still surprises me today how many mortgage advisors on the workshops that we've done up and down the country have followed this formula, which isn't my formula. It's formulas passed on by people far more capable than me. So take the big journey at the moment, which is renovation or equity acceleration. It's not the EPC kind of concept. An EPC kind of concept is something that we are hearing an awful lot about, and I'll come into that in a second. It's about taking a property at a value of X and accelerate it to a value of Y in a matter of days or weeks. And it's a property where you can make structural or changes that make big points of value. So if we take the EPC changes, nothing more than the current legislation of an E-rated property. If you've got a property that's F-rated, you can't rent it out. But you might just put a combi boiler in and it's E and it's lettable, it suddenly has a different value because to you, it's a buy-to-let. Without the combi boiler in, it's not a buy-to-let, it doesn't have a value. The legislation on EP changes is taught for another time. I don't believe it's fundamentally possible to bring the EPC changes into buy-to-let as a whole, but that's a conversation for another point. So when I'm buying property at the moment, the property that I look to buy is one where I can make an acceleration to the equity position within a very clear time frame. And it's about buying properties that maybe an older person's passed away, or there's been situations where something becomes available that's too good to believe. Most investors will look at maybe buying a property, maybe not in this state, and then renovating the new kitchen, bathroom. It's the simple cosmetic things we look for. Don't look for big structural changes. And when buying property, remember you're never going to live in it, and you're going to own it maybe for 60, 70 years. Some of the properties that I own, I got in my early 20s, which is maybe 15 years ago. And no laughing, please. And those properties, it's about that schedule of works, because if you look at the renters' rights bill, there's going to be a time frame of when a kitchen and when a bathroom has to be replaced. There's kind of a consequence to the standard of that home. So if you do have a property for a period of time, you will expect to replace the bathroom, the kitchen once. So I'm working out the share the budget. I mean, I've put down here £30,000 for a kitchen. That's at the top end. That's going to be for a southern-based property. It wouldn't be for a property in Teesside. Why? You buy a house in Teesside for £30,000. It's about making sure that the apportionment of what you spend makes sense. Don't go on grand designs. And it's things about being honest, going through each part of the house. So with kitchens, when I'm in a real sort of circle of buying and renovating, find a good kitchen fitter, a high-end one. They're constantly taking out board kitchenness. What's a board kitchen? It's where you got a posh wife or a posh husband, and they just get bored and they replace the kitchen because they've got more money than sense. That's going to skip. But if you can get that kitchen fittings, if you've got any decent kitchens, they can chop up a really good kitchen and put it in your house for next to nothing, because they're going to throw it out. The cabinets are assembled. They can just literally slot it in and maybe just a bit of tiling, and away you go. That's what I do. Same with bathrooms. Obviously things like tiling, but tiling itself becomes a consequence of maintenance. So I use these big, really posh laminate screens. You get one big sort of piece of laminate that goes against the wall, looks like marble. It's really impressive because it's about maintenance of keeping those tiles clean and the silicone, because your toilet, your kitchen and your bathroom are the primary bits that tenants look for when they're coming to looking fresh. Going through each room, the hallway, being absolutely brutal. Look at the roof. Your roof's maybe your biggest liability, and it's making sure that the cost and the works and everything's needed within that structure of ownership is okay. Things like windows, the legislation from HMRC on like for like. Remember, anything you do to a property that's a capital improvement is not a tax deductible expense. Hence the biggest down problem with the EPC legislation. If you are improving your property, like the EPC rating, and you spend £10,000, £20,000, if it's a capital expense, it's not tax deductible, so you can't offset it in your tax return till you sell the property. So you've got to really start to think about all these bits. But double glazing is loud as a like-for-like expense. So once we understand that, also understand the property, and HMRC's website's really good at explaining what you can offset in your tax return. But really understand your allowable expenses. And as you grow in size and skill. So think of this. If I was to recommend a mortgage to you today in a limited company, and it was a 7% fee, a lot of the mindset of landlords is, I'm not paying a 7% fee. No way. In personal names, I would absolutely 100% agree, do not go for 7% fee. But if you're a portfolio landlord who's got 20 or 30 properties, you would only ever want a 7% fee. Why wouldn't you? Why would you not have a 7% fee? Because what does a 7% fee do? It reduces the interest rate, increases your cash flow, and that 7% is 100% tax deductible. So as long as you don't have an objection of paying less tax, you're going to go for the bigger fee. But your accountancy practice needs to be very slick At the end of the 5 years, you make a capital repayment, that 7% fee off your balance before immediately taking out it again. So then when we come on to the equity position, this can be your own home if you're about to start the journey. If you haven't got a home at the moment, you do have to build some form of cash deposit. But for those that have got the benefit of their own home or a partner's home, or as I've seen in the past, it might even be grandparents who are prepared to lend their equity for 6 or 8 weeks to get you on your journey, then unencumbered properties are phenomenal. And remember, if you're working with another landlord as a partner, some people do, 55% of our lets have no debt. Buy-to-lets that are lowly geared and they've got maybe a significant amount of equity can become your friend, because you can take a second charge on those properties to borrow the equity for a short period of time. This is not a term loan. It's not a secured loan. It's an equity acceleration position for a short and calculated period of time. Then we come to what we call fully geared. If it's indebted, whether it be a first or a second at 70%, then they're not the properties to use for equity acceleration, because there's no benefit to a lender. What a lender would do is, if you had an unencumbered property worth 300,000 and the property you want to buy was 100, then the lender taking security over your backup property in the new property has got 400 grand of equity position. All you want to borrow is 100. Maybe you could do the renovation costs. You might be using the bridging costs. But at the end of the day, you're able to offer the lender more security than there is against risk. So if we take an example here, this is the backup property that I've used for years. And the one I always use in my examples, it's a 400 grand property. It's 50 grand on first charge mortgage with a very old lender that I just won't move because it's a cracking rate. It's got 350 grand's worth of equity. You offer that up to the bridging lender or the lender that's happy to do what's called a cross charge. Now, what a cross charge does is it takes a charge over the available equity on property A. And the property that we want to buy, let's say it's 100,000, I'm making this for simple maths, they put a charge over that. So you have a first charge over the purchase property and a second charge, in this example, over your backup security. The underwriter has got total value gross of the two properties, 550, but from an equity position, they have 100 there and 350 there. So you're looking at about £450,000. You want to borrow the 100,000. You want to be able to borrow any associated fees. So you might use it on bridging. So if you set yourself 6 or 9 month bridge, I would always advise to go longer in the term position, because you can redeem the bridge as soon as possible. And most bridging lenders, it's daily interest. So don't think I can do that in 6 months, because things happen like COVID. But in a situation here, you might buy this for 100, you might want to spend £35,000 on it, and it might be worth 170, 180,000 afterwards. Or you might just bought it at auction. The last house that I bought in Chelmsley Wood in Birmingham, do not buy there. Do not buy there, because I'm quite happily buying there at the moment. The returns are really good. 3-bed, ex-local authority flat, ground floor, and it was 110,000, managed by the council, £66 a month service charge, which is nothing. It's just rented out for £1,175. It's pretty good on 110. The property was part of an eviction, and when you went, it's quite sad. It was just full of everyone's crap. It was pretty awful in that sense, but the property was in really good order. So 2 good skips, a load of paint, cost a couple of carpets and some curtains, I reckon about £6,000. But the property didn't dramatically go up in value, but it was the ability to buy, renovate, and get the rental yield. Sometimes rental yield's bigger than equity acceleration. Equity acceleration will work better in London than it will in Teesside, or it will work a balance in the Midlands. It's those sort of ideas. So these are the scenarios that you can use and that you can put through. And then the exit can be refinance. So statistically, lenders like CHL, like Moda that I work for, they're quite happy You're buying a property for 100 from auction, it might have done hardly anything to it. And the valuation really is 130. If you bought for 100, it's worth 130. And lenders will go, well, I'm not happy with that. You bought for 100, it's all it's worth is 100. It's worth what the valuers say. So we're very happy to work on the open market value, as should all lenders. It could be the sale of the security, the property you buy, you might want to sell, flick. My advice would be the following. If you're buying properties and renovating and selling them straight on, the ultimate way is to do it as a residential. So if you are in between residential properties, that's the best way. If you do it as a business, don't buy and flip properties in personal names. You'll get away with it a couple of times, but after a while, it will be classed as a business and you'll pay up to 55% tax. So don't think of capital gains in personal names, because there's a point where it becomes a trading business. And then the sale of additional security property becomes another option. So I could have sold my backup property. So it's about understanding that. The day one remortgage, I've just exited my portfolio from the northeast of England purely just because of an age point. I'm in the next transition of life and I'm making more money in Birmingham now where I live because of HS2, and HS2 is really driving property values and growth at quite acceptable point to me. So you've got people now, investors, all my properties were sold to investors that were buying them below market value. In reality, I hadn't invested them in a period of about 10 years. So we're buying the properties at the point they needed investing. And a classic example is, say, this one here. Just imagine you've got an investor who wants to buy a house for £250,000 where they've identified equity acceleration. We're going to make this quite a neutral one. This is a classic example of the CHL. You've used bridging finance, 75% loan, £187 worth of debt. The most important thing with bridging finance, don't complete till you've got Bob the Builder with a van full of equipment ready to go in. The moment that you complete the property, or between exchange, if you're cheeky enough to get in and do the work, but you want to be in and out of bridging as quickly as possible. That's where you will burn your profit, but never think bridging is expensive. I find it a charitable solution. If the cost of bridging, taking away the net profit, if the cost of bridging, well, if you've made a net profit, you've carried your calculations, obviously work, but never look at the bridging as an expense. Look at it as a positive against your profit. So if you're going to have a cost of bridging of, say, 12 grand and the equity growth is 12 grand, you wouldn't do it. But if the equity growth was, say, 80 grand and the cost of refurbishment was, say, 20 and the cost of bridging was 10, you would consider it. Always look at the map. So in this scenario here, bless you, this investor is going to spend £35,000 to put kitchen, bathroom, central heating, paint and decorate, and double bays in a bathroom. That 35 grand will increase the value by 60,000. So you got up to a value of 310,000 and a 75% refinance 6 weeks later. That's standard. And lenders will do that. And in your situation, you might be not in an equity position where you've got no cash in, but you've deleveraged really well. And it's about understanding this journey of how it works and doing it within 6 months. The day one remortgage, anybody ever really thinks about that? What is a day one remortgage? 2007 is when it ended. And on a morning, you purchased a property with Newcastle Building Society on a bridge. And at 12 o'clock, lunchtime, it refinanced a return product with Mortgage Express. In this day and world, there's no way you could do a bridge in the morning. Jamie's my old friend too. You couldn't bridge in the morning with Jamie and then refinance with CHL in the afternoon for all sorts of reasons. Hence, we know why Mortgage Express failed. The fastest growing area for property investors now is holiday lets. The fastest and most lucrative area. In fact, it's a point. It's got a health warning on for that. CHL leads the way when it comes to holiday lets. And our number one destination is, I bet nobody in the room can get our number one destination is. Anybody want to have a go? Wales. Wales? No. Or outside. You were at that presentation before. Absolutely, that's not a joke. Wolverhampton. You might think, for the love of God, who wants to go on holiday to Wolverhampton? The concept of a holiday let is a definition under law. It's not a definition under your own mental attitude. In other words, a holiday let is it's a bit like Terry saying this, of course you're going abroad, it's a holiday. It's not a holiday. And yeah, I was a holiday let. But holiday lets are defined by not having a 6-month AST, a short-term tenancy. So the number one destination for investors for CHL is Wolverhampton, because they want to buy a 3-bedroom ex-local authority next to the Wolverhampton Hospital to put nurses and doctors up on serviced accommodation. So what you've got is a property next to the hospital and you do serviced accommodation in a HMO. The returns are there. Only warning, once your total rent, ignoring expenses, regardless what structure you've got in, your once you hit 85,000, the income's vatable. Remember that. So your Airbnb concepts. A piece of legislation came in October 2023. If you have a property that you put on Airbnb now, 1-bedroom flat, before you do that, you have to put fire doors in it. It has to have fixed smoke alarm, fixed electrical. So if you are going into serviced accommodation, the reason why HMOs, mandatory HMOs do serviced accommodation, they've got fire doors in already. It's part of the regulation. But you can't do a 2-bed serviced accommodation without fire doors. And it's understanding all the different nuances. So for instance, in Birmingham, if you bought a 2-bedroom flat in Birmingham and you were going to put 2 students in, or you were going to rent that property out, well, let's say you're going to rent that property out, it's a 3-bedroom, and you're going to rent it out just to 3 people, 3 individuals, 3 non-related, it would be illegal in Birmingham because it's an Article 4. So you must make sure you're aware of the Article 4s. The Article 4s were predetermined. So in Birmingham, you can't put 3 students in any house without having planning first, even if it's a 2-bedroom flat. And you can't do serviced accommodation without it having change of use to a different classification. And that classification can either be the C4 or it can actually be the C5. And it's about understanding those key points and what is sui generis. The great points for you is the journey we're going to go with Terry is we're going to be doing sound bites of 30 minutes to an hour to actually help you understand these fundamentals. The biggest single reason an advisor will now get sued and pay compensation from the ombudsman, it's not giving tax advice, it's actually one of the lowest. It's actually the planning advice that you accidentally give by the landlord saying, can I put 3 students in this flat, it's 2-bedroom. You have checked with the lender and your lender's happy with that. What's it got to do with the lender? The primary reason is the planning. And don't ask the licensing department because they don't talk. So then when we then move on to limited companies, if you said to me today, Roger, I don't want to talk about limited companies because I'm terrified either to explain to myself what forming of a limited company means or to a customer. The most complicated question you can ever ask myself or ever be asked when it comes to limited companies in general is just literally, what am I going to call the company? That's it. That's as complicated as it gets. When you go into all the other things I'm going to cover off, that's a level way above of which we wouldn't advise it. So as long as you can get up the name, the formation of an SPV, specific purpose vehicle, required SIC codes is 934. You can then, the hardest part will be opening a bank account, and the formation of a limited company works really good and will help you do this. We then look at the 3 SIC codes. There's only 3 SIC codes to pick if you're running property. So pick a good name, pick the 3 SIC codes, you're done. When it comes to limited companies, 93% of all purchases today are purchased through an SPV. Why? 3 primary reasons. You can offset all the interest and the lender fee. You can charge interest on your director's loan. So if you put equity in a buy-to-let in your own name, you get nothing for it. You put it in a limited company, you can get up to 7%. And the last is succession. If you think, imagine you were lucky enough to have a house in London worth £1 million. If you wanted to give it to your daughter, you'd have to sell it. And you'd have to then pay stamp duty. And the stamp duty is quite high. In a limited company, it's 0.5%. So it's the stamp duty variation of IHT mitigation that becomes really powerful. If we then understand about holding companies themselves are for the more sophisticated. So where Terry's moving, as Terry's accelerated his businesses, He'll have a holding company that maybe owns his SPVs, which if the SPVs goes wrong, it stops a further claim further up. But most likely with Terry's businesses now, as he's involved, he's got trading businesses, he's got a holding company, and then that will hold shares within the property. Now, you might say, well, that's great, Rog, but I've got 15 properties in personal names. How do I get them in a limited company? There's two primary considerations of moving property from personal to limited. First is capital gains. Now, capital gains can have the right for an individual, not a partnership, an individual, and also a partnership. So the two separate things. Partnerships have the right, but so do individuals, to transfer property under Section 162 into a limited company without capital gains being paid, without a time frame. But you've got to qualify for it. The other is stamp duty. Now, stamp duty comes under the 1890 Act of Partnership, Section 45 of two or more individuals coming together. And that partnership doesn't need any of this LLPs. That's normally done for a scam. Just literally fill out a form, create a partnership, make sure you meet the rules. Partnership needs to run for 36 months, and potentially they have the right to transfer into a limited company without paying stamp duty. The two cannot be mixed up, totally separate. The vast majority of people, unfortunately, don't qualify for this. But again, that's something else we'll cover off. You might then come against, or might want, a much more complicated limited company. So here we have Mr. and Mrs., got the son and daughter, director 1 and director 2, and then we've got a trading business as shareholders. You might want to put a family income trust around this because you've built up a lot of equity. You give it to your son and daughter. You never like the son's girlfriend who became wife. 3 years down the line, they get divorced and take a lot of your equity and cause refinancing. By the shares being in a trust, your son and daughter don't technically own it. And then alphabet shares become a thing of beauty. So alphabet shares is the ability to have B's and C shares and the ability not to give voting rights, dividends, and other potentials and payments. So we look at the holistic approach. Think about this. The way HMOs are going now, it's about upchanging them, putting en suites. It's about then moving into different types. So this is a property I have right opposite the QE Hospital in Birmingham. It's literally, it's like it's closest to the United Stadium. I kicked out the tenants, well, at the end of their academic year with great happiness. And what I did was, if anyone knows a Georgian property, a coach house, so what used to keep the horse and cart, is now short-term, fully serviced accommodation. Got kitchens, got bathroom. The other one was here. And then what you then do is go en suite. But the difference in income generation that 8 unit can give you, because the surgeons just want to wander over. And then the other thing we do is we take the cars and put that into secure car parking. Because again, by hospitals, there's nowhere to park and it's stressful. And if they've got the big Mercs and the Cadillacs or whatever they call it, works. And then with the multi-unit freehold buildings, so after COVID, the sort of mid-sized HMOs were converted into one-bedroom, self-contained flats, but they had to split the services. And then when you look at the variation now of multi-unit freehold buildings, the self-contained flats, and then also sometimes you've got different other variations of where we're now seeing multi-unit freehold buildings work and operate in different ways than they did before. The world is changing. And it could be, this is a 6 unit, it could be a 10 unit multi-unit freehold building with each unit as a mandatory HMO with every single bedroom being rented out on serviced accommodation. And then it kind of comes to my favourite. I remember when I created this property, which we called the Mill House, and everybody in my sales team says, there isn't a property like this out there. Well, there's an amazing young gentleman came to my stand today. This is not pre-done, said, and he described his property, and I went, you mean this? And what you've got here, one mortgage application would be applicable because this has got 1, 2, 3, 4, 5. This is just a 6 unit multi-unit freehold building with bounds of income and potential. So all I'm finishing off by saying, is what the Wealthy Advisor Club is set here to do is to take you on a journey. Today's just the beginning of the knowledge. But I would give you one very negative comment about what Terry's going to do to you, particularly on my journey. One negative comment, and I'm not a negative person. If you think about what I've done, any of the consequences of the tax liability you may make when you die many years from now, because you could potentially be a multi-millionaire. And as long as you can live with making fortunes from property, then maybe come with us on what could be quite an unusual journey. Terry, back to you.